Okay.
Yeah, but tomorrow is still a day. Yeah.
Excellent. So
Yes,
we can start off.
Yes, sure. So hi everyone. I hope you also had a good trading day and you're having a nice evening as I do. Today we are going to cover a session that is trading price action and RSI. So at this point, we are going to cover two bits in the market. That is understanding the price, and also we will include one indicator. We call it RSI. So when we talk of RSI, we are talking of relative strength index, and we'll be measuring divergence in that or using that indicator. So right now we are going to start with the price action, and we want to understand what is price action in the market. As the name suggests, this is the action of the price, if you can put it that way. So basically, it's good to understand that when we are trading, we cannot control this market. We don't have that enough funds to control the market. And again, we don't have information on the kind of buyers in the market or the number of people who are buying in the market or even the people who are selling in the market. But we are able to read who is in control in the market through understanding the price action. So price action is very important for any trader. Reason being, you will have to understand, or price action will assist you to understand who is in control of the market and several factors. So as I said, when you open your graph, you'll be able to see the price, that is the financial asset price, and the movement will be represented by that graph. So basically, when we talk of price action, we'll be analyzing the graph. So it involves analyzing plain asset price graph without adding any indicator. So that is the price action. You want to understand what is the price doing by observing the or what are the buyers and sellers doing in the market by observing this movement. The other thing, it's good to understand that when you're doing price action analysis or when you're doing the technical analysis, what are you looking to or what do you want to understand in this market? As I said, price action will assist you to understand the behavior of buyers and sellers. And with that, you'll be able to make a decision on the market direction. That is, if you see price has a strong bullish movement, it means buyers are in control. And since we cannot control this market, we cannot reverse this market, you will want to ride that direction. That is, you'll be able to know the market direction. And then the other thing, or the other factor that you'll be able to understand is identifying the demand, or as other people call it, the supply area. And again, you'll be able to identify the supply or the resistance areas on the chart. That is, if you want to buy an asset, we don't buy assets at very higher prices. You want to identify lower prices, and not only lower prices, but you want to identify lower prices that create demand for you to take a buy. So you don't want to buy an asset that doesn't have demand. So you want to identify that that area has been creating demand. So that's you'll be able to identify that demand area through observing the price action. Also, supply area, it's where we'll be expecting to sell our market. So you not only identify higher prices to take sales, but you want to identify higher prices that attract sellers. So the price action, yes.
So if I may cut you short, what you're trying to say is that by demand or support, you're trying to say that it's an area or a zone which would tend to attract a lot of buying activity.
Yeah, sure.
And supply is the zone or the area within which most sellers would find attractive prices to sell.
Good, sure.
Okay.
So the reason as to why we want to analyze the price action, what the price is doing, it's for us to read, does a certain area create demand? We'll be able to see that on a chart later. And does a certain area attract supplies? Then the next thing that we'll be able to read through price action is market structure. So remember, in an uptrend, you don't just buy market because the prices are rising. We have areas where you need to buy these prices or this asset or a particular asset that you're trading. Again, in a downtrend, you don't just take a sell. because the prices are dropping. We have areas where you're supposed to take sells. Otherwise, you'll find like, or you'll see like the market is playing games with you if you don't obey market structure. So market structure is very important, and we're able to identify market structure through the price movement. We'll also see that later. And again, price action will help you, will assist you to identify trade entry and exit confirmations. So what do I mean by trade entry and exit confirmations? For example, at this area, we have a support and resistance, as I had explained, that a support is, we can also call it a demand area. And this is an area where we will be looking to have entry points for buyers. That is a support or demand. And again, at that demand or support area, it's where we get to exit, or we get exit points for ourselves. So this lower zone here, as you can see it, this is the demand area. As you can see, this asset or this pair that we have here is EuroCAD. And you can see at this point, we had a good buy. Then market came back to that point. It had a very strong rejection, and we had good buys. So with these two confirmation, we could have said that this will be our demand area, because we can see that at these lower prices, when this pair gets to this point, it tends to attract buyers. And then this is an area that we call resistance or a supply area. And you can see initially at this first point, we had buys before we got to this point, and then we had a very strong sell, meaning this area attracts sellers. And then market came back to that point. You can see a very strong sell, which is confirmed by previous data, what the sellers had done. So if this market comes back to these areas, we'll be taking sells with this confirmation of a price action, what the price is doing here and what the price is doing. And again, at these areas, we'll be looking to get demand. So in my initial point here, I talked of trade entry and exit confirmation. It's good to note that when you get on a resistance, you don't just take sells. So it's not guaranteed that because the market is on a resistance zone, it will have to drop. No, we can have a breakout. So you will need to have a confirmation that the initial momentum of buyers has faded away, and we can probably we have sellers coming back to the market. Again, when you get to your support zone, you don't just take buys because you had drawn a zone there and the market is at that point. So you need to identify confirmation of buyers for you to take buys. So that is what we talk of entry confirmations. So you can observe the price movement. What is the price doing? Are the buyers still controlling the market, or are we seeing some sells? So at that point, you'll get confirmations by observing price movements.
And it's good that you mentioned that, because in as much as this has happened, it does not necessarily mean that it's a guarantee. And
Sure.
that is what most people tend to misinterpret as support and demand areas.
Yes.
As some interpret it as a guarantee. It's a guarantee that price has to react that way. So basically, you're waiting for the market to come towards these zones because based on how the market has been behaving in the past, there's a likelihood that that might happen. It's not a guarantee.
Sure.
But then again, relying on what happened, you'd want to take your trade along that zone because it's sort of a sweet spot. So should it occur that price will react the same way, then you'll be in a good position to make money out of that. If it fails, then you'll be able to exit with a minimal loss. So ideally, these zones give you a good reward to risk ratio. So every time you seek to enter trades along these zones, you should ensure that you observe proper risk management in order to ensure that if it doesn't go the way you are anticipating, then your position is well covered to help you to part with the least amount of loss, However, if it pans out as you had intended before, then you'll be at a good place to make the most out of that opportunity.
Yeah, that's a good point, Edwin, because sure, we have seen that problem where traders just draw zones and take trades on that zones or on those zones without having proper confirmations.
Yeah, and more importantly, without putting proper risk management tools.
Yes, sure. So that is it, guys. We need to read the price, what the price is doing on these zones, and then after you take your trades, of course, apply the risk management on those zones. So if you have taken a sell here, the stop loss will be above the zone, slightly above the zone. Give it a reasonable distance. And if you have identified the demand area, you take buys on these demand areas. Your stop loss should be below that demand area, meaning if the price gets to your stop loss, then probably it has broken your zones, or else it's not obeying your analysis. So that is what we have on support and resistance. Then remember, also when you get to those support and resistance, as I said, if the market is on a demand area, you're expecting buys, market will form a certain structure. So market structure enables traders to identify best entries after identifying market direction. Then with this knowledge, traders are also able to identify market reversals after break of structure, trend lines in trending market, and break of horizontal zones in sideways market. So it's good to understand that, because the first structure that we have here, this is an uptrend. So this is where the prices are appreciating. And we said that you don't take buys anywhere. So if you took a buy at a higher high, so the HH here represents higher highs. So we have higher highs and higher lows, higher highs and higher lows. And we can see that we are supposed to take our buys at higher lows, these areas. So if you find yourself taking buys at this point, market can reverse against you. And if you don't have the right information, you might think it's a reversal. Probably you close your buy order in a loss, and then you start taking a sell because you thought it's a reversal. And then immediately you see you take a sell, then the market again goes against you. So once it goes against you, your confidence is already gone. So you cannot take this move. So it has already confused you. You find that if you don't obey these structures, the market will confuse you. You will tend to take trades without the proper knowledge of the direction. So you should identify this kind of a structure in an uptrend market, and then you take your buys at higher lows. In a downtrend, market will form this kind of a structure. You don't take sells anywhere. So it's advisable for you to take sells at lower highs. And once you take sells at lower highs, of course, the closing or the exit area will be guided by your trading plan. That is, if you're trading a number of pips, if you get the number of pips, exit the trade. Probably you are targeting a certain zone, or else you're targeting, whatever you're targeting according to your trading plan, should give you an exit. But once you see the market has already moved, don't dare to take a sell because there will be a likelihood of market reversing against you. I don't mean that if you take a trade at this point, market cannot continue to drop. Yeah, we can still have sells, but as we said, this is not the right point to take a sell. So you should identify lower highs, then you connect your lower highs for you to take your sells. So we have that uptrend structure, we have this downtrend structure, and then we have a sideways market or a sideways movement. So sideways movement is where the market gets to create a horizontal demand area or a horizontal support zone, and also create a horizontal resistance area or a horizontal supply area. At a horizontal supply area, that is where we have higher prices. And on higher prices, that is where we get to take sells with confirmation of historic price actions. So if the price has been dropping at this point, then when we get to that horizontal area, we should be looking to take sells after we get a confirmation of presence of sellers. And on our horizontal support, after the market gets to these points, we should look to take buys after having a confirmation that initially or historically, these lower prices have been creating demand, And before you take your buy here, as we said, you need to see a confirmation of presence of buyers. So if you take a buy, I will be expecting either you have seen this uptrend and you're taking your buys on higher lows, or else you have identified a sideways market and you are taking buys on the lowest prices that create demand. And if you're taking sells, I expect you have seen this kind of a structure and you're taking sells on lower highs after identifying a confirmation that the trend will continue, or else you have identified a sideways market and the price is at these highest prices, and you have already seen a confirmation that yes, there is presence of sellers and this zone we are going to respect it, then those are the scenarios where you can take buys or sells. Yeah, you can still take sells or buys in the middle of a trend, but those won't be high probability trades. They will have a high risk. So the best opportunities will be at this point, but still you can get opportunities in the middle of a trend. So it's good to understand that, Edwin, we have different kind of traders.
Yes.
The first trader is the one who has experience in the market and they can do the right technical analysis, or not say the right technical analysis. They can do analysis and they are able to confirm that, or they are able to see that this is a higher high according to me. So I won't take a buy. And they can do analysis and identify lower lows in the market, and they are able to see that this is not the right point to sell. But we have other traders who do analysis and are not able to identify that a certain move is already exhausted. So they find themselves taking trades when the move is already exhausted. I don't know if you have seen such a case.
Yeah, it's quite evident, and that's why we always insist that there's need for you to have a broader view of the market. So it's good to check charts across various time frames in order to have a clear understanding of the general structure of the market. Otherwise, if your analysis is based on one time frame, then there's that risk that you might get yourself into a trade at a point which is way off, or a worse off point, as opposed to you finding the most optimal entry. So
yes,
it's very important to ensure that you check different time frames in order to understand how the market is, and therefore be better placed to identify the most optimal level
and to make the right decisions. But again, we now introduce some of these indicators. So these indicators will also assist us somewhere. So I always say, if you cannot do analysis and identify those higher highs and higher lows, if you have that kind of a challenge, you would want to add an indicator to your chart. And for us, we are going to add relative strength index, which will serve two purposes in this case. So RSI, as I said, it's a relative strength index and it's a technical indicator that we'll add into our chart. It measures the magnitude of the recent price changes. And then, of course, they have history. The RSI was developed by J. Wells Wilder in 1978, and it has been working so well. That is why we are using it. So it oscillates between 0 to 100. So it's good to understand that it's an oscillator which oscillates between 0 to 100. The price is said to be overbought in a state when RSI is above 70 and oversold when the RSI reads 30 and below. So we have two zones there. A 70 to 100 will give us overbought zones. Meaning, if you identify an overbought, probably your market is creating a higher high. And it's not advisable to continue with those buys. Yes, buys might continue, but it's not advisable to continue with those buys. And then 0 to 30 will give you oversold areas where the market, probably the sales are already exhausted. So you may not want to take trades here. If you can't do analysis and identify a lower low, if you add RSI and then it indicates 0 to 30, if it's a downtrend, probably your market structure is at a lower low. So we'll be using this indicator to identify those overbought areas and oversold areas. And again, we will add a middle point level, which is 50. So with that middle point level, a 50 level, when it's above 50, we'll be expecting some strong buys. And when it's below 50, we'll be expecting a significant downward move. So that is how we are going to add our RSI, and to serve that those two purpose, the purpose of overbought areas, oversold areas, and then the second purpose that it's going to serve us is to identify divergence. So divergence occurs when the RSI indicator starts to reverse before the price does. So a indicator does contrary to what the price is doing, then it indicates that the initial momentum in price movement is fading away and a potential reversal might occur. So it's good to note the word potential reversal. So it's not a must when you see a divergence, automatically you expect a reversal. In that case, a trader can identify a bullish divergence or a bearish divergence. When you talk of bullish, it means buys. So for bullish divergence, we expect buys to continue. For bearish divergence, we expect to have sells. So bullish divergence, we expect that reversal for us to get buys. Bearish divergence, we expect that reversal for us to get sells. So with this strategy, it would be advisable to identify a bullish divergence pattern on an oversold zone. Remember, we talked of oversold zones giving us buys, and if you combine it with support, it will be better, because on support or demand area, we expecting buys. And then you use this indicator as a confirmation that yes, on that point where you're expecting buys, also we can see the sell momentum fading away. Then the bearish divergence, it's advisable to identify it on overbought zone. Mostly it happens on overbought zones or under resistance area on a chart for high probability sells. So you find that on that supply area or resistance area, it's where we're expecting sells. And then you want to see a certain confirmation of buyers fading away or a bullish momentum fading away, or bullish momentum fading away for us to expect some sells. So it will have those two purposes, to give us the divergence and also for us to identify the overbought and oversold zones. So at this point, we have an example of a buy setup that is for a bullish divergence where you expect bull market to take control in the market. So at this point, when you talk of price action, now here you are able to identify a certain structure. So this technical analysis, you are able to see that market was creating lower lows and lower highs. So we had a good sell until our indicator. So this the lower red dotted red here, a line, it's our 30 level, which indicates oversold zones where we expect reversals. And this upper line here, the dotted one, is our overbought area. That is 70 to 100 where we expect some sells. And then this one is the 50 level. So I want you to identify or to see this clearly, what happened here. Initially, we were creating a downtrend, but after getting to this point, we created a bullish divergence. It's also good to understand that, Edwin, we have different kind of divergence. Where we have regular divergence and hidden divergence. Yes.
Okay.
So this one is a regular divergence. So with this one, we can see market is creating lower lows. So we have a lower low, but our indicator, which is RSI, is indicating something different. So we have a low here, and then we create a higher low. So meaning there is a probability that this momentum is fading away. So what you do for you to get good confirmation or good trades, after doing the technical analysis and identifying that these sales probably might not continue, you want to see a breakout on the upper side from your technical analysis. So this is what the price is doing. So we have broken out from this trend line, the downtrend, and we can see market creating some new highs. Then from there, we can see a good uptrend that is confirmed by RSI remaining above the 50 level. Remember, we said when RSI is above the 50 level, it means we will have some good movements. So this was on a 4-hour time frame. So this was a good movement for some good days. So that was a nice setup for buying. And then we have a bearish divergence, still a regular divergence. You find that, so in the charts, we'll be doing the practical part, we'll try to identify some hidden divergence. So you find that technically we had this trend line and the market was trending on an upward direction. And then after getting to this area, something happened. So market was creating new highs, but our indicator or our RSI was indicating something different. So it means that this bullish momentum was somehow fading away.
So basically what you're trying to put across is that
Yes.
The movement on relative strength index or any oscillator that a trader might be using should correspond with whatever is happening on price action. So if the market is attaining new highs whilst the indicator is attaining new lows, it means that there's a divergence, yeah?
Yes,
because under normal circumstances, they should match.
They
if
should
the market
match.
is creating highs, the indicator should also be creating highs and vice versa.
Yes, so if they are creating something
right.
different, then they indicate probably there is something wrong.
Okay.
So at this point, we can see we had that divergence. So what we wanted to see, we were not supposed to take sales anywhere, but after breaking this trend line, that is why it's advisable to do the technical analysis on your charts. So after breaking these trend lines, automatically or according to our analysis, it should have shown that there might have occurred a reversal. So after that, we needed to confirm that our RSI is below 50 levels. Remember, we said for good sales, we need to remain below 50 levels. And then we can see we had some good sales for several days. That is a 4-hour time frame. So this was several days where we had some good sales. So that was a nice setup. If you can identify these kind of setups, it's advisable to identify them on higher time frame, probably 4-hour time frame, for you to get some good setups. You can also identify them on lower time frame, but then maybe you may want to scalp because the trade might not last that long.
All right.
So I think with that now we can go to our charts, and try to identify one or two, and then I would like Edwin to take us through that.
All right. So today we had a very beautiful example of a similar setup. So Michael, if you can allow me, I want to share my.
You can share it. So as you share, by the way, trading divergence, it's a good strategy also.
Mm-hmm.
I have been using it for some time.
Try to make me the host, kindly.
Okay. Just a minute. So as I was saying, I have been using that strategy for some time, and it worked well for me. Have you used that strategy before?
Yes, I do. Like, I'll try to explain with the trade that I've taken today. Just click on my name.
Yeah, try to share. I've allowed you to share.
Oh, okay. Excellent. So today we have had a very beautiful example on an hourly chart. Are you able to see my MT5?
Yes, I can view it.
Yes. So we had a beautiful example on pound against Australian dollar. So if you look at this pair on an hourly chart or 4-hourly chart, you'll be able to see that the price has generally been pushing higher for quite some time, since mid-February. Then as time went by, I noticed that on Friday price was approaching the trend line. So price was retesting the trend line. So on an hourly chart, you'd be able to see. So this was today. So from where we have that period separator, so this is generally today. So at some point, late hours on Friday, the market had pulled back towards that trend line. So it was retesting it. So that had caught my eye. Then when it comes to divergence, you'd be able to see that through this trend line, you can be able to see that right from this point, the market seems to be making higher highs. And from what you can see with the shaded rectangle, you can be able to see that that area is sort of acting as resistance. So not only do we have resistance forming along this zone, but the highs that the market has been making since towards the end of March have been generally, they've generally been a bit higher. So if you compare this high and the previous high, this was a bit higher than the previous, and so was this. So this was higher than the previous two highs. So if you compare that, or at least if you compare these two latest high points, so if you compare this higher high with the latest higher high, and try to see the reaction on relative strength index, you'd be able to see that there was divergence. So the highs that were being formed on relative strength index were slanting downwards, while those that were formed on the price action were slanting upwards. So there was sort of a divergence. That coupled with the fact that price had come back to retest that trend line, then today early in the morning, the market broke below that trend line. Then from the start of the day, you'd be able to see that relative strength index was basically riding below the midpoint. So that was signifying that sellers were increasing in the market, or the sales were generally increasing progressively. So if you are keen, from around 10 a.m., you'd be able to see that that is the point at which, actually from around 9 a.m., that's when the market began to gain a bearish momentum. And since then, the price has generally been pushing lower. So right from 9 a.m., price has dropped by around 150 pips. And I should also mention that around this point, there seemed to be an area of support starting from, let me mark it, starting from this point all the way. This was sort of an area of support. So you could have as well marked that support in order to see whether the market would sustain the bearish momentum that was taking shape. And as you can see, right at this point, when the market broke that support, you could have been able to capitalize on that rally further down. So if you had said that support, ideally could have gotten anything between 0 up to around 130 pips. So this was a nice setup. So
That was a nice
closed
setup.
it. Yeah. So this was my entry. So if I put it in line format, you'd be able to see my entry and exit. So that was the entry. At the break of that support, I held it up to that point, and that was roughly how many pips? Let me see.
So again, there was a point that we are talking about.
That was roughly 70 pips. Yes.
the point where when you get to a demand area, like you have drawn here a support area that was broken.
Yes.
So if somebody took buys, that person was technically right because we had a support zone.
Yes.
But then, so we talked of confirmations.
Yes.
So we needed to see confirmations on that zone. Will it hold or will it break?
Yes.
But now the indicator RSI had indicated there is a probability that this support might not hold. Also having a confirmation of breakout of trend line. Yeah, so there we have several confirmations.
Yeah, so it all boils down to confluence. Not only did you have a break of trend line, but you also had a relative strength index forming divergence. But to top it up, the fact that RSI had broken the midpoint, so from Friday around 5 p.m., that's when a relative strength index broke below the midpoint. So market was leaning more towards selling. So it all boils down to how well you're able to check different things or looking at the setup from different angles in order to ensure that there are different triggers which are supporting your argument. So yeah.
And then could you say that after maybe the trade or let's say RSI readings or the RSI went down all the way up to 30, that is, it got to our oversold area, you could have exited at that point. Probably after you took a sell, that is around 9 a.m. to 10 a.m., you could have exited after the RSI got to oversold zones.
Yes, but you can also check the momentum. So if the market is forming long bearish candles, then that might also signify that there's a lot of sell volumes are being floated in the market. But yeah, as relative strength index stretches towards the lower extreme, then that might help you to know whether it's a good point for you to exit.
Okay, that was a nice setup.
Yeah. So I think that's basically it, not unless you have something to add, Michael.
No, the only thing that I can say is that so it's good to combine such an indicator with technical analysis. So if somebody wants to use that strategy, kindly first do the technical analysis, the price action, understand what the price action is doing by identifying your demand areas and support areas. They can be horizontal zones and they can also be trend lines, that is diagonal zones. So once you identify them, then you can add RSI to serve those two purposes. One is to identify the oversold and overbought zones, and then the other one is maybe to identify divergence where it occurs or when it occurs. I think that's all on my end, Edwin.
Yeah, just to mention, tomorrow we have interest rate or cash rate decision by Reserve Bank of Australia at around 7:30 a.m. So it's good to alert our traders to be on the lookout.
Yeah.
And yeah, so the expectation is to retain the rate at 3.6%, as was the case in the previous month's reading. Then there was an article that I was reading, and the argument was that based on a survey that was conducted, where 42 experts and economists were interviewed on the future cash rate moves and other issues relating to Australian economy. Over 2/3 of those who are interviewed were of the opinion that there's a high likelihood. Actually, 62% of those who are interviewed were of the view that the rate might be increased tomorrow. And out of those, 60% were predicting that there might be an increase by 25 basis points, bringing the rate to 3.85%. And I tend to feel that that might be the reason why Australian dollar has been quite strong today. So that is that is to be confirmed tomorrow at 7:30. So be on the lookout. And if you're holding any Aussie pair, you need to be careful, or you need to be on the lookout. And we shall see how it turns out tomorrow.
Yeah, and it's good to note that those are economic events that also
Yes.
cause price movements. And
Yes.
once if you want to understand the economic events, or you want to view them, we have economic calendars that you can use. Maybe Edwin can name a few of them. So Edwin, which one do you use?
Investing.com and tradingeconomics.com.
All right, for me, I tend to use Forex Factory.
Okay.
Yeah, but if they use any, they will be able to see those economic events when
Yes.
they will be happening and
Yes.
the impact expected in the market or in the prices.
All right.
Yeah.
So I think we will stop there, and we want to thank you all for finding time to join us. So we look forward to having you soon, this coming Wednesday, for another session. And we wish you happy trading. So
Nice
see
evening.
you all. All right. Have a good night.
Okay, thank you.